Welcome everyone to September's update for Wattle Partners. My guest or my business partner, as usual, Drew Meredith. Welcome, Drew.
Good to be here. Busy month.
Crazy month. I want to start with this.
Bring a prop.
Yeah,
we know Jamie loves props.
Collingwood.
You've got to pull it out properly.
I can put it on if you want. Collingwood won the premiership, which, being a loyal supporter for the last 48 years, it's only our third premiership. So it's probably the most significant.
16 in total though, or 17?
The record. We've got the record equal with Carlton, but they cheated in a couple. We a pretty special September for me anyway. Don't worry about markets. Don't worry about what's happening in the Gaza Strip or anything else. But it's just about me.
Just the football.
So, all right, let's start at Gaza.
We're recording a bit late this time, so coming out later than usual. But yeah, it's been massive. The Gaza-Israel conflict, which kind of came out of nowhere, right?
Yep.
Came off the back of, we've had Ukraine and Russia, which, I mean, a lot of people thought would end pretty quickly. And it's kind of dragging on, having impacts on supply chains, energy price, all these sort of things for a long period of time now.
Absolutely. That was a big one, right? Geopolitical risks. Some people picked it. Euro-Asia picked what was going to happen in Russia, but no one really picked this and the impacts that Gaza-Israel is going to have on the global economy. The global economy or global markets are kind of in a downward trend anyway and have been for the last 12 weeks, so it's hard to really see if it has affected anything at all.
Yeah, and it's hard to predict. Like, there's so much data comes out and research on these sort of things, and we're not going to make a call or take a view on anything.
Sure.
But when it's these localized issues, it tends to have less of an impact on the global economy. Tends to.
Sure. Gold and energy's gone up though. That probably could be a direct or indirect, probably a direct effect of that.
Yeah, I think people tend to, when there is conflict and uncertainty, people tend to turn to safe haven assets. So like bonds, government bonds, popular, not so popular this time. And gold, surprisingly, it had fallen pretty heavily in US dollars in the last few months and then turned around quite quickly on this. But then the other thing people tend to do, or global investors, because everyone's a global investor now, is bring all their money back to the US. Yeah. So the US dollars rallied, which sent the Aussie dollar lower, which means gold has hit a record in Australian dollars of $3,150, which is, compared to the US dollar price, which I think is just over 2,000 at the moment.
Yeah. Yep, absolutely. And, we've always been long gold in domestic currency, so it's worked out pretty well. But the currency is getting low, isn't it? It's getting close to 60 cents. So you don't want to travel there. I saw our credit card bill from last month, Drew, and it doesn't look good if I work out what that hamburger did cost. It's like a $60 hamburger.
We shared the hamburger.
Yeah.
Half.
We did, that's right. You did want to go half, which was a great idea. $30.
Calorie driven, not
not price. But
the other big trend was this Ozempic. So it's like a obesity and dieting, or it helps people.
What are you saying?
It's treatment for diabetes or different types of obesity. It's, I think, Novo Nordisk, so it's actually a holding within quite a few funds.
Sure.
Definitely in the Munro Fund,
Absolutely.
like one of the biggest global companies in the world. But I think there's quite a few people, a few groups that have worked on this technology.
And it's listed in the US?
Novo, I think it might be Europe.
Okay.
But there's two, I think, not Pfizer, there's a couple of other groups that have a similar treatment.
Yeah, okay.
And basically it helps with that kind of weight loss, but they're not 100% sure, or I think it's an appetite suppressant actually.
Sure.
So it helps you.
But they found it by
less
accident,
hungry.
didn't they?
I think so.
Yeah.
And it's impacting everything.
Diabetes got really skinny really quick.
But there's no confirmation about how long you can be on it for, what impact it has over the long term. So it's still, the drug is around, but the testing isn't quite there
I
yet.
saw some stats. It shows that 80% of what you lose is your muscle, your lean muscle. It's probably not what you really want to lose.
Less. But it's had an impact on everything. So like, I was listening to a podcast on the way into work today, and they're like, Pepsi is going to be impacted by it because maybe people drink less Pepsi. But two biggest ones in Australia.
Why don't they drink more?
This is the thing. This is what happens in markets, and someone mentioned like
that's a good example of market, right? You go short Pepsi, I go long Pepsi because someone's got a diet pill out.
There's an echo chamber that I think ends up in financial markets. Like AI this year was probably one example, and this.
Sure.
So CSL and ResMed are both down 30%. I've been getting quite a few questions about it in the short term, and CSL is because a big chunk of CSL's business comes from kidney dialysis treatment.
Yep.
And there's this assumption that lower rates of obesity will convert to lower needs for dialysis or other treatments.
Sure.
But that's like extrapolating a very short-term trend
Well,
into a
they
long-term
should get
impact
into
on
it
the
as well.
business. And then ResMed is sleep apnea, right?
Oh, yeah.
So
Which is all driven by weight.
yeah, but then I went to a lunch with Australian Ethical, and
Oh, yeah.
they were talking about this idea that sleep apnea treatment as a portion of the market is still incredibly small, and the market itself is still growing, even if the incremental demand is less.
So they're quite
lower rates
bullish
of
on
obesity.
ResMed, were they?
Yeah. Positive on ResMed, and I think both. You're always going to see, and this is what happens in markets. You get these short-term trends.
Yep.
Call them trends, but they're not necessarily a long-term change to the outlook for that company. And both companies upgraded or held earnings, and they're both going to grow at 8 to 10% in the next 12 months anyway.
Let's fast forward to a major change that we've had internally. Well, a couple of them, but it's probably the most boring change that any client will think. We changed the components of our asset allocation.
Yes.
So do you want to talk through that?
Yeah, I think it's kind of the evolution of our business, but also kind of reflecting on what's happening in markets in the last 2 or 3 years.
Yep.
So if you read the papers, everyone talks about interest rate increases being like this extraordinary experience. Yes, they've gone up quickly, but we're just returning to what should be a normal environment. You should be getting 3 or 4 or 5% for cash in the bank. Cash should be a real asset class. You should be rewarded for saving money.
Sure.
We're kind of seeing a return of that. And I think what we've seen across even professional, sophisticated investors like pension funds is that no one's really changed their approach based on the higher interest rates. I know you're quite famous and influential now. You wrote an article in The Australian quite recently.
Read me every couple of weeks. The next one's coming out about geopolitical pressure from China.
Be interesting.
It should be.
I look forward to reading
What you need to do.
But the article was about the ability to hold cash, and SMSF's holding cash. This isn't a bad thing, particularly when you can get a return on it. And I think that's part of where the way we've essentially introduced 2 new asset classes, and it's a need to look more deeply when we're building portfolios for clients. And golden rules has always been about building resilience into a portfolio. So the 2 big changes is maybe we'll start with the alternatives. So historically we've had defensive and growth alternatives.
I think that's just acknowledging that alternatives are a part of mainstream portfolios, where historically we split them out. So we still have an alternative bucket, but we don't have a low risk alternative bucket. So
An alternative is just an asset that's different to a bond or a share. Or acts differently in different market environments.
I think acknowledging alternatives are a part of mainstream portfolios. The second issue for me was making sure that we don't have too much equity risk in retirement portfolios, which there historically been a lot of equity risk, e.g. Say superannuation funds have been driven by just the performance of equities, and that's something we want to reduce over time. So bringing in asset classes like real assets, which is essentially real property and real infrastructure, is essentially important, I think.
Yeah, exactly. And then we've split. So essentially, you've got an alternatives asset class that is similar to what it was before. So there can be some private markets investments in there, or anything that acts differently to what bonds and equities do. Then you've got real assets. So as you'd expect, tangible assets. Gold sits within alternatives.
So we really just split the fixed income into duration and floating.
Yeah.
So
Duration being sensitive to interest rate movements, and
just
floating
traditional
rates.
bond fund, the old school bond fund, right?
And then floating rates just similar to your mortgage or your bank account, that when interest rates go up, you get more interest. When they go down, you get less interest. And we think, given how fast interest rates have moved and how much uncertainty there is, it's important to look at them quite closely and consider the risks of those a bit more. And so the quarterly reviews should be out by the time this video goes live, and you'll be seeing that in a full explanation in there. And then there are a few changes we recommended within the portfolio.
Let's talk them
which
through.
fit within those new buckets. I mean, the main one was basically introducing more government bonds, and this time Australian government bonds to the portfolio, and that's pretty straightforward in our view. As you were saying, we rely a lot on equity risk, and the income, working with retirees, that everyone is very focused on income, but sustainable income. The problem with equity risk is you can get about 4% income from holding the ASX 200. We can go buy, or what we've recommended is going to buy Australian government bonds, AA, AAA rated, and you're getting an income of 4.5%,
Yeah.
guaranteed by the government.
Yeah, if you go back to 101 portfolio construction and the concept of asset allocation originally coined by Markowitz, is that long duration bonds are incredibly important to build stability into your long-term portfolio, right?
Yeah.
So everyone knows that we focus on retiree capital, retiree money, retirees, and it's important that the value of the total capital they have stays relatively stable in the process of producing income and growing over time. And the trick to that really is to make sure you do have long duration assets. So when equity markets fall, interest rates fall as well, which means the value of bonds goes up. So you want true diversifier, and long bonds for the last 5 years has been a little bit forgotten, and we're reintroducing them back to the portfolio.
I mean, it's an asset that we've avoided for the last 2 or 3 years.
Well, luckily we avoided it last year, which was negative 15%.
And good reason. I mean, I think the last 2 years have been the worst 2 years for government bonds in close to history. So that's why we're comfortable now, because when interest rates go up, these are interest rate sensitive assets, and what we're saying is whether interest rate increases are finished, there's less chance of it going higher and higher from this point, or there's less upside and more likely for it to be cut next within the next
so
few years.
technically you're increasing duration. We're doing it through an indexed option, so it's low cost indexed option.
Yeah,
right. IAF.
Exactly. Yeah.
And you'll get a good distribution. You'll get some you'll add capital stability to the overall portfolio. If interest rates were to fall off over time, you might make a little bit of capital gain.
That's why bond yields, and it's reflected because bond yields are at a 16-year high globally. The US and Australia, we haven't seen this high since the.
We saw rates
GFC
come off a little bit, but then go back up. So that's probably. I was talking to some people on the weekend, and they're all business owners, and they were talking about this two-speed economy, and we're definitely seeing that. Anyone with a mortgage and the mortgage belt is hurting, and hurting. I think 1 in 5 mortgages in that belt are in some kind of distress. But then you've got retirees. This is actually a pretty good time to retire, right?
They're the ones causing the inflation, apparently.
That's right.
Apologies.
Well, you saw that in inflation numbers last time, didn't you? Offshore trips had gone through the roof. I don't even know how that's in our inflation numbers, but
that's what Alan Kohler was talking about on the news, that because interest rates are going higher, retirees are getting more return on their cash and savings.
Yeah.
So they get more to spend.
Well, you feel more. You have to feel more comfortable
too,
wouldn't you? You'd feel more comfortable if you knew you had a corpus, a pool of capital, and that pool of capital was producing 5% or 6% without any risk, right? Versus if you retired 4 years ago, you could get 0.2 in the bank.
Yeah.
There's a bit of risk to that. So.
Yeah, exactly.
Okay. Let's go on and talk about the introduction of SMAs and why we're introducing SMAs within our portfolio. Are you comfortable doing that?
Yeah, of course. So defining a separately managed, SMA stands for a separately managed account, which is essentially the ability to outsource the investment decisions for your portfolio to someone like us, but to do it with giving us some level of discretion to make those decisions. And there's a few reasons we do that.
Yep. So it's like an automatic portfolio essentially. So at the moment we're on a manual type process where every quarter we send you recommendations, and we call it non-discretionary. Send you recommendations, and you go, okay, I like this or I don't like that. Send it back, and we execute. So all those trades get executed over the next 12 weeks. Some clients don't send it back, and it might be 15 weeks or 16 weeks.
There's an implementation lag that we found there.
Yeah, which just means you're buying at different prices.
Yeah.
Some clients. So this is really just an option to put your portfolio on automatic. So when Drew and I make a change to our model portfolio, and those recommendations, e.g. Like IAF, where we're sending out 250 odd reports to clients saying this is what we want them to do. If you're a part of the SMA, we would have already done it.
Yeah, the good thing here is that the portfolio is the same as what we've always managed, and the only difference is it's discretion versus non-discretion. So whether you want to decide whether on the timing of each of those investments, or if you're comfortable for that decision to be made. And it's not forced, as you said. It's an option. We'll provide more information to to everyone over the next few weeks.
Yeah, so it's really just introducing new products to what we can offer our clients.
Yeah.
And the clients I see most will benefit this from most are the older retirees, where they're having trouble reading the reports, they've been with us for a long period of time. The clients that are relatively financially not illiterate, but essentially don't want to be bothered every single day. All the reporting's still the same, the portfolio's still the same, and probably the smaller clients that historically we haven't serviced before. But if they're children of our clients or they're looking to build a portfolio, this is a good way to essentially access us as advisors. So more information will be rolled out. Of course, we're using our firm, Atchison. Atchison is our asset consulting firm that sits right beside Wattle Partners. They've been building and managing SMAs for the last 20 years, so lots of experience there. One of the reasons Drew and I acquired them about 2.5 years ago is to provide this service to our clients.
And they sit on our investment committee as well. So we've got some more not rigour, but more size around our investment committee.
There's really good governance being put in place on our investment committee and the process that's we undertake to change and research investment options.
And we've got quarterly reviews coming out shortly. So the performance generally to September was quite strong for portfolios. One of the highlights, interestingly, was the fixed income and the lower risk allocations in the portfolio. So something like Yarra did incredibly well because the yield coming off it. I think the Invesco senior secured fund, so the kind of disruption that's occurred in markets means
Yarra is a credit fund which would fit into your fixed income floating and it's Australian bonds and loans.
Yeah, exactly.
So
that's yielding something like 7 or 8% income at the moment from lending money rather than taking equity and having the additional volatility. So that's been a bit of a highlight. And then the GQG fund, which we probably talked about a fair bit in the past.
Which is a global fund, sits in global equities.
Yeah, exactly. And they've had Novo Nordisk, so the beneficiary of Ozempic, has done quite well. But they've also had a fair bit of exposure to the AI and kind of big tech theme, so the Magnificent Seven. I couldn't name that. Amazon, Apple, Alphabet, Nvidia, Microsoft,
Facebook,
Meta. I'm sure there's one more.
I think it was 7.
Got close. But basically, they've driven 80% of the returns from the S&P, so from global markets, this year alone, and actually most years. So
I attended actually a Yarra lunch, and they had the CEO and the economist there, and they were talking about how, and there was actually a good debate around the table. It wasn't just a presentation around how global markets are priced. And if you take that, what did you call it? Magnificent Seven out of the S&P 500, then you'd get a PE which is pretty reasonable in historical terms. But even if you looked at that Magnificent Seven and if earnings go the right way, then they're trading on about 26, 27 times. Now, I'm comfortable in buying any of those stocks at 26 or 27 times.
Yeah, definitely.
On their individual merits, right? So markets don't look incredibly expensive at the moment.
And you caught up with Oaktree or Spire Capital and Oaktree?
Yeah, I think everyone knows that one of the asset classes that we've done incredibly well with and continue to recommend is kind of quite a unique asset class called distressed debt, special situations, if you like. Opportunistic, but essentially it's when bonds go wrong and people buy them at less than $100 in par value, and then work with the company to fix whatever problem. It might be a financing problem, it might be an operational problem. And historically we've used SVP out of the US, invested with them more than 10, 12 years ago. We do know that that is kind of one of the portfolio managers there has transferred over to Invesco. So we're actively investing in the Invesco Special Situations Fund. It's a really good fund. They have different tranches, but they essentially is in small to mid companies that they're essentially activating. We were looking for a larger manager, and of course there's no one bigger than Oaktree, right? So
Howard Marks, everyone, he's quoted in the papers all the time.
Everyone reads his quarterly, he's been quite, it's quarterly or annual letter.
Did they buy Pacific Brands, I think? and maybe the Blue Sky. They were one of the people that helped roll Blue Sky out at the end. When Blue Sky failed, involved in extracting all the assets from it.
Well, Oaktree let them some capital at some very appropriate rates. I made a lot of money from Blue Sky. I'm not sure anyone else made money from Blue Sky, but so essentially they lend. They've got a pile of capital, and they lend to special situations. So companies that have issues, or company that needs transformation capital, then Oaktree is sitting there. So Oaktree, the fund sits incredibly well beside the Invesco fund. So for some select clients that are looking, it would definitely fit in our alts bucket.
Yeah.
It doesn't have equity risk to it. It has a different type of risk, a risk that non-correlated to anything else. So.
I think, and probably the last point is around our basic investment concept, which is active share. I know it's not necessarily directly related to.
No, I'm not going to answer that, Drew. You answer active share better than I do.
But this concept that if you're going to pay fees, so we've put forward a low-cost index fund as a bond exposure. It costs about 0.08%.
It's free.
Or
Right? Let's call it free.
Yeah. So what we try and do is go, if we're going to spend your fees or fee budget, and we're going to employ someone, we want that to be truly different. And that the one big one is Oaktree. That's incredibly different. There's only 3 groups that do that basically in the world.
Sure.
So that's a fee we think you should be willing to pay for, given the long-term return.
You mentioned a couple of things there. You mentioned fee budget, which is really an institutional concept.
Yeah.
So if you're allocated, and the concept is relatively simple. If your portfolio has got a certain amount of fees that you want to pay, or are happy to pay for that portfolio, where do you spend it? Do you spend it on the core of your portfolio, or do you index it for free? And then the excess you get out of indexing that, are you better at chasing specific strategies? I've always had the mindset that it's all after what matters is the after fee return.
Yeah.
A lot of people get hung up on that, and in public markets, I don't think the after fee return has been that great versus an index option. But in private markets, the numbers have been quite substantial. The SVP fund that we invested in 2012 hasn't quite finished yet, so we're talking about a lockup of 10 years plus, and it's on run out now. But that IRR would be in excess of 18%.
Yeah.
It'd be getting close to 20% if you brought currency in.
Yeah, definitely.
So lock up your capital. Pretty expensive fee. Obviously, they've done really well and they get paid on performance fees.
Yeah.
So it even looks more expensive on a historical basis, but they're probably making upwards of 2.5%.
Yeah.
Which no one would pick a fund manager at 2.5% going forward. But I'm sure that every one of our clients does not care on the 2.5% because they've got 20% compounded for 10 years.
Exactly.
So fees are a hard one, but I think if you approach it from what do I get from paying this fee, it's a bit more appropriate. So.
That's the whole point. And active share as a concept is basically saying if you're going to pay a global equity manager like GQG, who I think the fee there is 0.6, 0.7%.
Yep.
Compared to the index, which we can buy for free or zero, you want to make sure that is significantly different. So an active share is basically how different that portfolio of assets is to the index.
Yep.
The higher, the better. So 100% active share means it's completely different to the index. If it's too low, it means they're tracking the index a lot.
Yep. What's the number you want? Or I suppose that matters. That depends on what other assets you have there.
Generally, you're looking for, the active share can be the weightings compared to the index as well as the individual holdings. And I think we look for anything above 85 to 90% if we're adding an active manager, because we want them to be truly different. If we're going to allocate and attract that fee, they have to be doing something really different.
Sure. I think we're actually, in these set of recommendations, we're also increasing or adding, which we haven't had for 5 or 6 years now, a small cap manager.
Yes.
And active share, I know it's not technically right, but the active share on that versus the whole portfolio, it would be essentially 100% because we don't hold any small to mid cap Australian stocks within our core portfolio.
And that's how you get true diversification.
And then we're adding this pool. We're using a manager, Ausbill, and it essentially brings in 50 or 60 different investments into your portfolio by investing into just the Ausbill small cap.
Exactly. Yeah.
Small caps managers have shown over a long period of time, they can add about 400 basis points, 4% better than the index over a long period of time.
I think at least half of Australian small cap managers outperform the benchmark compared to something like 20% in large cap.
Is that right? Yeah, okay. So there's obviously lots of inefficiencies in that small cap market, and we're using Ausbil. So in our set of recommendations, or the recommendations we've provided for you, you'll probably see that we're increasing small caps in your portfolio.
Perfect.
What else we got, Drew?
That's all I got for today.
Yeah, great.
Month.
We've got our retirement
Event on the 26th.
Depending on how quick our man is in the corner. We might have already had it, or if not, you can come along. It's on which day? Thursday night, is it?
Thursday afternoon from about 3:30.
Okay, all about retirement.
The Meridian, yeah.
And who's speaking?
Yourself and myself,
Of course.
and
Yeah,
Owen
sure.
Rask,
Yep.
John Glass, who was featured in the Financial Review
yeah,
on the
sure.
weekend.
Yeah,
So
yeah.
he's a retirement coach. And then we've got some people talking about relating investments back to retirement. So Reece Birtles from Martin Curry.
Reece is fantastic.
Who has a very good story about how his family business led him to investing for sustainable income.
Yep.
Chow Ma from Munro talking about the role of long-term themes within retirement portfolios. We tend to think in retirement our investment horizon shortens. It's actually still incredibly long. And then Stuart Robertson from Australian Ethical, who's going to delve deeper into a bit more about ethical investing
And values.
Yeah, exactly.
Yeah, great. Well, thanks everyone for listening. Thanks, Drew. See you next month.